Hi, everybody. Thanks for joining us today. I am Sandra Crawford from Alice, helloalice.com, which is a free platform for business owners to start and grow their companies. And today we are joined by Lisa Wang from SheWorx and Howie Diamond, a general partner at Alpha Bridge Ventures, to talk all about building a scalable business model and team. So Lisa will be moderating, asking Howie your questions. So feel free to drop them into the chat or the Q&A function anytime during this. And then we will be answering those and going through those. So this is a office hour brought to you by PepsiCo's WomanMade initiative, which is supporting women founders in the food and beverage industry. And Lisa, would you like to take us away?
Sure. Welcome everyone to today's live Female Founder Office Hours. My name is Lisa Wang. I'm the founder of SheWorx, and I am so excited to have everyone here who is part of the community at WomanMade. I'm here today with Howie Diamond. He's the partner at Alpha Bridge Ventures, and we will be talking about how to build a scalable business and model and team. So especially if you want to build a venture scalable company, understanding what to focus on is extremely important. So Howie and I will do our best to share insights around your questions today. And before we get started, I want to just say a quick thank you to PepsiCo for making these office hours possible and Alice for hosting us. This is going to be an engaging, informative hour. And as you hear interesting quotes or valuable nuggets of information, I highly encourage you to write it down and engage with us on social. And as we continue with the conversation today, also please share your questions in the chat area. And we'll start off with the lesson, and then we'll get to as many of your questions as possible, whether on Facebook or on Zoom. So before I introduce Howie, just take a moment to write in the chat what your name is and what city you're from, and we'll give you a minute to do that while I introduce Howie. So, all right, without further ado, today we are joined by Howie Diamond. As the general partner of Alpha Bridge Ventures, Howie works to identify and evaluate promising early stage tech companies that seek funding. He conducts due diligence on all potential investments and helps quarterback overall operations for Alpha Bridge. After living his dream of managing and performing in a major label rock band, Howie founded and sold a music management licensing company in LA called Lo-Fi Music. He moved to San Francisco afterwards and began working closely with dozens of startups, running biz dev for a Bay Area tech agency called Spark Art. And through this experience, he was able to start his own early stage venture fund called Ranch Ventures in 2015. He was previously on the founding team of a Y Combinator backed biotech startup called Immunity Project and is currently a mentor at 500 Startups and Runway Innovation Hub. And he is a graduate of University of Colorado at Boulder. And just healthy pleasures in Colorado. Hey, Cindy from New York, and Shinru also from New York. So we have a bunch of people all tuning in. But without further ado, I want to hand it over to Howie. And Howie, just to get started, tell us about the investment thesis that you have at Alpha Bridge and what gets you most excited about companies.
Yeah, it's so great to be here. Thanks, Lisa. Alpha Bridge is basically the culmination of the compounded learnings that I've had in 10 years doing early stage venture investing. And I want to just modify something you said. I don't just invest in tech companies. So sort of one of the things that I learned is that there's great investment opportunities outside of tech. And that's why this is such a great panel for me to be on, because CPG, consumer, e-commerce, direct-to-consumer subscription has been a pretty big focus area for myself as I've sort of navigated the early stage investment waters. I realized, I don't have a super technical background. So I was diligencing companies that were a little bit like outside of my sort of purview or skill set. And it was very difficult when I would look at, deep tech companies or companies that have, technical or scientific complexity that I just didn't quite understand. So I kind of like shifted my focus to an area that I did understand, which seems pretty obvious, but like it's hard to do that in real time. But you just start to find sort of verticals that you feel you have an understanding about and that you feel comfortable and familiar with based on your experience or just whatever your domain expertise is. And for me, that ended up being consumer. So Alpha Bridge Ventures, I'm a general, one of the general partners at Alpha Bridge. I focus more on consumer. My partner focuses more on the deep tech. So I partnered up with someone who does have that sort of expertise, and we're focused on companies in a very specific stage. So kind of ramping up to their Series A, their first institutional round of financing, we found was a really interesting place to invest from a risk-adjusted return standpoint. And there just frankly is not a lot of venture dollars going into these bridge rounds or these post-seed rounds, as you call them. So we're focused on that stage primarily. And again, I look at consumer, my partner looked at deep tech. So we got both ends of the spectrum covered. And the other thing I just wanted to mention about our fund that is a bit different is, and this also came from the learnings that we've had over the past 10 years from both Jake and myself, is that there wasn't a lot of support services that were going into helping founders grow as leaders. And we thought, as a platform, maybe we could provide some services that could really help founders perform at their best without personal sacrifice. And we've gone through it ourselves as former founders, entrepreneurs, former solo fund managers. We have deep empathy for the founder journey, and we know everything that our founders go through because we've gone through it ourselves, and we know it's a very isolating and lonely journey. We know how challenging it could be from a mental, emotional, and physical standpoint. We understand how difficult it is to manage co-founder relationships, as well as to build a team and create cultures that are going to attract and retain top-level talent. All the soft skills and all the people-related skills of building a business sort of went overlooked in terms of companies, growing in the beginning, in the early stages. And there's a lot of VC firms that have platforms to help the companies grow. There are very few, if any, VC firms that built platforms to help the people behind the companies grow. And so we wanted to take a more humanistic approach, a more people-focused approach. And we brought on a third partner, Dr. Carrie Sullins, who is a PsyD in clinical psychology with a concentration in organizational behavior and development, to build what's essentially this integrated health program that's applied to leadership development for all of our founders, which we're really excited about.
Awesome. So on that note of the founder, what makes you the most excited when you meet, the founder that you want to invest in?
Yeah, I think there's the founders, and I guess this goes back to the program that we built. I would always look for the sort of human character, the characteristics of a person that weren't just about company building, but about like the adjectives that I would look for and characteristics were more along the lines of grit, determination, perseverance, winning, the will to win at all costs, right? Because in the early stage of a company, a lot of times, you're building something and you might need to pivot, or you may not have product market fit, or, it's not necessarily the first idea that wins from a founder. And I'm mostly betting on people. And so what really struck me when I would go through that sort of diligence process with people, and I would identify these qualities in certain founders that I just knew that this person was going to figure something out. I had a sense about them that they're just not going to give up until they figure something out that actually works. And I started feeling kind of sad about that as I went through my thought process, in the sense of, I don't want to invest in people that are willing to do whatever it takes to win at their own personal sacrifice. So that's, again, why I think we built this program, is to make sure that they don't burn out, to make sure that founders have all the support that they need, so they can keep that resiliency and that grit and determination, all those characteristics that I look for in a great founder, but not have to worry about them, again, hitting a wall, burning out, having all these detrimental health issues that are caused from having, being built a certain way, which is, overachiever kind of mentality, and have a work ethic that is kind of off the charts. So anyway, those are the types of personality traits that I look for. And now we have a program in place that sort of acts as an insurance policy to endure, make sure that the founder endures across all those potential challenges.
Well, I know that there are, even all the women who are listening to this chat who have the grit, right? They have the determination, they have that winner's mentality. But if we bring it back to the tangible part, before they become your founders, right? That you're going to make sure they don't burn out. How do you actually demonstrate that in an investor meeting? What are some things that you found that founders make mistakes in that make you question that they wouldn't do whatever it takes?
Yeah. So look, you also have to fundamentally know your business and know the market and know what you're building. And so one of the things that I look for is when I ask the founder about their metrics, and I have this luxury of being able to ask that question because I'm investing a little bit later in the seed spectrum. I'm, again, doing post-seed. So a lot of these companies that I look at are in market, they have customers, they have unit economics and so forth. I want you as a founder to know your numbers like the back of your hand, like it's your birthday, like it's your telephone number, like it is, you don't have to look these numbers up. That gives me a lot of confidence that you know your business really well and you have a fundamental grasp on where the business is today, the growth of the business, and how the economics are working in the business, and what are the milestones that you need to hit to get to the next level. And I think it's just like a simple thing for founders to go into a pitch meeting. And it's actually pretty rare, but when I see it, I'm very impressed. And I just feel like more comfortable that founder, really understands their business well and doesn't have to like go to the spreadsheet to look up the numbers. So that's like kind of an easy thing that founders can do when they go pitch is make sure you really have an understanding of that.
Got it. Okay. So now as we go into the actual business model, what kinds of business models are most interesting to you? You talked about the consumer side, but at what point do those numbers actually become interesting to you?
Yeah, I mean, on the consumer side, I really like the disintermediation of direct to consumer, and sort of, it's interesting because direct to consumer is not really a business. It's more of a channel for customer acquisition, I think. And so, but when you launch a specific type of consumer brand, which a lot of the companies that I've invested in do have a subscription model, like Quip, like Fem Care, like Barn and Willow, you get, it's really exciting to be able to acquire customers and then be able to capture a lot of the margin that you're getting because you don't have to sell, you're not selling your product wholesale. And so all that margin is going back to the company. What's interesting about that business model is that you can't stay at direct to consumer the entire life of the company. You need to expand into what's more of an omni-channel online offline approach, which is what a lot of consumer brands are doing now. So you start with direct to consumer. That's exciting because you're capturing margins, you're acquiring customers, you're paying for those, the acquisition prices are a little bit higher than they were before through Facebook and Google ads, but you're really able to tell a story directly to the consumer in a way that is super exciting online. But then as you evolve that business model, you need to think about wholesale and you need to think about being in retail and create this omni-channel approach, because it becomes a flywheel for the consumer to really discover your product, on shelf at one of the big box retail shops, purchase your product, and then come home, use the product, love the product, and then there's ways to get that consumer to sign up for your subscription model once they have the product at their home and they're using it. So I think that's been a really interesting kind of trend that's been happening recently. And I think consumer founders need to think of more along the lines of this omni-channel, where yes, you're giving up less margin when you do go to retail, but it's sort of a necessary evolution of the business model, because I don't think you can just win on direct to consumer alone. I think you really need to think of more of a comprehensive approach in terms of acquiring customers and then also distributing and getting your product out there from a discovery standpoint.
Okay, great. And again, because we've emphasized the number side of it, when you talk about the numbers that they should know, like the back of their hand, like what are some of those key metrics?
Yeah, so I think you know, there's a metric that I like to call, or I guess it's called the fundamental law of growth. So it's the cost of acquisition of the customer, and then the LTV of the customer, and typically that ratio, it's a ratio, it needs to be 3 to 1. So you're getting a 3 to 1. The value of the customer that you're acquiring is 3 times more. The value of that customer is 3 times more than the price of the acquisition of that customer. So I think it's important to understand how much, how much it costs to acquire customers. I think it's important to know, obviously, what your net profit, what your gross margins are, what your net margins are, what the unit economics in terms of cost of goods, all of your pricing you need to know, top line revenue, run rates, kind of a lot of the standard stuff. I don't really ask like too deep of questions in the beginning in like an early pitch meeting, because a lot of that stuff will be in the data room. But a lot of that, like the high level kind of stuff, is important for you to know.
And what about looking forward, let's say 5 years out? What kinds of projections are you expecting?
Yeah, so it's important to, these are projections. So you kind of have to, there's a interesting balance when it comes to projections in terms of like the reality of what seems attainable in terms of like your growth in 5 years, but you also want to tell a story that you feel like with the influx or with the addition of venture dollars, or with or equity financing, or with the addition of debt financing, you really have to demonstrate that. This is another important thing. You have to demonstrate that you understand how financing works for your company, again, whether you're raising equity or debt, and how that financing is going to translate into exponential growth. And so, I really get excited about companies that say, here's where we are today, but we're going to evolve the company across multiple product lines, and we're going to get to like a 10x, an order of magnitude level of growth over the next 5 years, if not more than that. But I need to really believe that story, and you need to back that story up by virtue of basically the use of proceeds, how much you're going to raise, whether it's dilutive, whether it's non-dilutive, and then how that money is going to be put to work in order for you to get to those larger levels of revenue. And then also, it's always great to talk about the economies of scale and how your profit margins are going to go up, because as you hit certain levels of scale, your costs will go down. And so it's always great for you, as revenue goes up and profit and operating costs go down, then you'll be able to see that sort of influx in the margins as well, which is I think an important thing to talk about.
Mm. And is it important for them to show a break-even point within, let's say, those 5-year projections?
Yeah, I mean, ideally, it's more than break even. I mean, ideally, you have profits, particularly for CPG. I think it's really important to show that you have a path to profitability, if not, a sustainable business model that, you don't need tens of millions of of equity financing to build a successful 9-figure consumer CPG business. I really don't think. I think people sometimes get confused when they're launching CPG or consumer company, that they have access to capital, so they should just take it. I think it's more important to really hone in on creating a viable business model, have a path to profitability, have a sustainable business model where, really simply the costs to make the product are, and like the amount of cost to make the product versus the amount that you're selling the product, it's like that needs to make sense. You can't have negative margins. And if you do, then there's something wrong, like fundamentally with your business model and your supply chain. So I think it's really like with consumer companies, what I like, it's back to basic business building. It's, building something that people want, that are willing to pay a premium for, because you're solving a problem, or you're creating something that has like a self-identifying benefit to it, or self-expressive benefit to it. And they're willing to pay more money than it takes for you to manufacture it. And it's just, and that is the sort of mindset and the mentality that I think consumer company founders need to have versus like, let's raise a bunch of money and we'll figure out the business model later, but we have, access to all this money. First of all, I don't think you won't have access to a lot of equity dollars if you can't show a path to profitability in this space, number one. And number two, there won't be any debt financing either available or revenue-backed financing for you, because that is all predicated on like having a business model and profitability. So I think it's really important to think about that from the onset.
So do you think that is actually, given the types of companies that we see, like Uber, right, like WeWork, where there's still no profitability, like, do you actually think that the way that you're speaking about this is an anomaly, given the juxtaposition of what kinds of companies we actually see continuing to raise money?
Yeah, I think it's important to talk about like which specific sector these companies are in. And so again, I want to say that I'm speaking specifically to CPG because I think our audience is a lot of female CPG founders. So I don't think you would see the Ubers or the WeWorks or the negative, or those types of companies that have negative margins. And by the way, a lot of these companies also are putting the money that they're making, their profits, back into the company for R&D and whatnot. So if WeWork decided to stop growing, I think their financial model would look a lot different. If Uber stopped putting money into autonomous vehicles, I think their financial model would look a lot different. For CPG, you don't really need to invest those dollars back into like innovation. So I'm specifically talking about this vertical, and I just don't think, that there is an endless supply of capital for a rosé and a can company as there is for an Uber or a WeWork or a Bird or a Lyft or any of those companies that could continue to subsidize the cost of their losses by virtue of the SoftBanks and these mega funds that are coming out that will back these companies. Those funds are not backing CPG consumer companies as much. So I think it's really important to talk about these on a case by case vertical basis.
Okay. As we think about scale, then, what are the types of team members that are most important to bring on to continually create a successful consumer business?
Yeah, I think like a head of sales, someone who has experience in relationships with retail is really important, because those as you again expand into omni-channel, I think it's really important to have those relationships pre-baked. It just makes the process a lot easier when you're trying to get on the shelf in some of these big box retail stores. I think a digital marketing team is really important, and branding is really important, because we live in a world now that's really exciting in terms of being able to connect with customers in a very new, authentic, and direct way. And so you're able to tell a story to a customer now, your story, and directly to that customer, and you have the opportunity to be as compelling as you want to. And so I think it's really important to exhibit authenticity and ingenuity when you're telling these types of stories of your company and why you're so great. And if there's an environmental or ecological, impact, or a social impact, or, if it's, you're building something that's affordable and accessible, basically why you're so great, telling that story and having, a content team and a digital marketing team working hand in hand, and a branding team to be able to tell that story in the most effective way, I think is super important. Yeah. So I think those are probably two areas that would be important as you scale.
So it's really the outward facing marketing, sales, branding.
I think as you scale, yes, those two are very important.
And how do you vet out hires? How can you know that someone is, I think, especially when a lot of founders get money, it's like marketing, and there's this budget for marketing, but how do you actually vet out if that's hire is good?
I think they say there's a saying, hire slow and fire fast. I like to employ trial periods with employees, which sometimes can work, sometimes can't work. I think, if there's an undeniable hire that has, the most reputable, resume that has worked on companies that have been at a, higher level of performance than your company. And it's just like a no-brainer that you're able to like either poach them or get them to work with you because, it's maybe even below their pay grade. And that's what you always want, is to get someone to work for you, to like make a sacrifice to come work for you that could probably work somewhere else and get paid a lot more, but they work for you because, you're building something that they really believe in more as a mission, like more missionary, less mercenary type of people. So that seems like an obvious hire. When those people present themselves, you should make sure that you can lock them in as quickly as possible. But for the most part, you're not going to be able to find, those people to fill every role. Maybe one or two roles you can fill with those people. For all the other roles, I really like the idea of trial periods and like working for a 3-month period or so and seeing, once the honeymoon phase is over, kind of like dating, see if this person really fits the culture and really you vibe with them on a day-to-day, how they fit in working with the rest of the team and so forth. You usually start to see that after month 1. So like in month 2 and month 3, you start to see people's true colors on if they're going to be a good fit or not. So, do it slowly if you cannot commit up front, because labor laws are pretty intense. You want to really feel comfortable that when you go all in and hire someone, it's the right hire. So I think a trial period is a good way to get out in front of that. And so I also just want to say that I fundamentally believe, if you haven't noticed already, I'm a very like people focused person when it comes to business. I think all businesses are predicated on, the people that are behind them. They're the cornerstone of any successful business. And so the team you build is the company you build. I fully believe that. I think that was a Kosla quote. It's not the idea. It's not the business model you build. It's not the product you build. It's the company you build. It's the team you build is the company you build. And as a founder, you don't always want to be the solution. You want to build the solution. Really the only way that you can build the solution as you scale your company is by hiring, a great team and hiring the right people. So it is, to me, like the most critical aspect of company building. And so you really have to take your time to make sure you're hiring the right people.
So that leads to my next question, which was, what are some of the biggest mistakes that you see founders making in the growth and scale process? And it seems like, one of them is if you hire the wrong person, but are there any other mistakes?
I think that, I guess I hate to go back on trying to like plug my own program, but this is the reason why I started this program is because one of the biggest mistakes is that founders did not spend time, growing themselves as leaders and figuring out how to, again, acquire the soft skills that are going to make them a great leader, that's going to build a culture, that's going to attract and retain top level talent, that they're going to be able to communicate and manage their team efficiently and effectively, because if they don't do that, they won't build a team. And if they do build a team and they don't have those skills in place, the team is going to leave. And so really spending time on leadership development and people skills and communication and all of that is like mission critical. And there's actually data to back this up. This isn't just anecdotal. So pre-product market fit, the existential threat of any company obviously is building something that people want. Once you figure that out, hands down, the most common existential threat for companies post-product market fit in their growth it's going to get past the point of no return, because once you raise that Series A and you have $5 to $10 million that you have to put to work, things move so quickly that if you don't have the sort of foundational tenants in place of leadership, then you're just never going to have time. You're never going to be able to catch up and be able to lead properly. So I just think that is is one of the things that is super important to focus on early on.
And what are those foundational tenets that you guys have built into this program?
I think a lot of it starts with your own personal health and well-being. So the program really focuses first in terms of, focuses on doing an assessment and identifying sort of the bright spots and the dark spots in your life and the focus areas that you want to strengthen and improve across emotional, mental, and physical health. We kind of talk about this idea of, healthy founders, healthy, happy founders build, the best companies or the healthiest companies. And I really think it's true. It starts with like you feeling good every day to then be able to lead, there's a higher probability of you becoming an effective leader. So it starts from a biological standpoint level. And then it sort of morphs into on the leadership development standpoint. I think it's important, again, to be able to have empathy for I think empathy is a big one. So like understanding, who the people you're working with are and where they come from and sort of what their motivations are. And, maybe some things, everyone's different. And so it's like really important to understand where each person is coming from, whether it's on an executive level or on a employee level. Really important to like understand, have empathy for the employees, and then just or for your team, and then just standard like communication training. I think I see a lot of problems that don't get solved in companies because there's just not effective communication channels in place. And I also feel like this morphs into culture as well, where in hierarchies and stuff like that, where people on a team, even early on, feel like they don't have a voice or they can't go to the founders to talk. This is like the team that's built, whether it's the founding team or the team that's built like outside of the co-founders. So maybe like the first 10 to 15 employees. We need to empower these people to really have a voice and to express their opinions, because a great idea can come from anywhere. And sometimes the founders lose objectivity in terms of what's right for the company and the direction of the company. And you have a team there that you brought on, that you hired, that you're supposed to lean on, not just for their specific roles, but I think they can be helpful in terms of seeing the big picture and, helping with strategy and seeing if something's wrong or if you're telling the story, the wrong way, or if it doesn't align with the values of the company, even from a marketing standpoint. So I think it's really important to communicate and empathize with your team members and really empower them to, speak their minds and talk about, what's the best interest of the company, because you want that sort of objective perspective from everyone on your team.
Got it. That makes a lot of sense. Quick question from Cindy, one of the founders, who's asked, what are your thoughts on crowdfunding sites such as WeFunder and Republic being used on entertainment, such as Legion M raising film production funds starting at $100 shares? I'm looking into something similar for live entertainment, so curious how an investor views that type of company currently.
I don't have a lot of experience in that particular space, unfortunately. I used to be in the entertainment industry, but I don't invest in that sector that much. I will say that I think it's, I don't know how much I can speak on equity crowdfunding, because I've never participated in equity crowdfunding fundraise. I've never put any of my companies up on one of those sites before. So I don't want to really misspeak. So I don't really know how to answer that question, because I don't invest in that particular space and I don't have a lot of experience working with equity crowdfunding. But I know that there's a bunch of sites that are out there right now. And I will say that sometimes if a deal comes to me that is on one of those sites, there's some adverse selection, sort of negativity bias that comes to mind, in terms of, I think if the companies couldn't raise from traditional funding channels, like, is the equity crowdfunding platform sort of their last resort? Like, it's not a primary funding channel that I think is as credible as some of the other funding channels. And maybe they're in the process of like building up that credibility and reputation, but just from an investor standpoint, it's sort of comes off as a little bit like I'm a little bit skeptical about deals that come from those platforms.
So to challenge that, if you are looking at a consumer company, right, and if they were to use, for example, whether it's Kickstarter or a equity crowdfunding platform, and it was a direct indication of people's willingness to buy the product, like the actual community itself, who are the consumers who would want to invest in it, want a piece of this because they believe in it that much. Could that potentially even be a positive indicator?
It could, yeah, that's a good point. And I guess equity crowdfunding is different than Kickstarter crowdfunding. So Kickstarter crowdfunding could validate that there's a need in the market and could validate that, this is something that people want. And, if I saw a Kickstarter campaign, that was a product that I was really excited about, I think, and I discovered it organically or it came to me, I guess that wouldn't be a negative indicator. I think I would want to, if anything, maybe dig a little bit deeper into the company as a CPG company with a product that I could, because, really what's the difference between discovering a product on a CPG product on Kickstarter that sold? I mean, it's not raising money, you're selling your product. So you could sell your product on Kickstarter, you could sell your product online on your website. You could just, on Kickstarter, it's easier to sort of unveil like the optics of how much you've sold, which I guess is a little bit easier from an investor standpoint to like from a signaling standpoint, like, maybe you've built something that people want and you found product market fit, versus if you go to someone's a product website, you don't know how much has been sold and so forth. So yeah, it's a good point, Lisa. I think for CPG, even though I've not invested in a crowdfunding campaign before like that, I don't think I'd be as sort of turned off by it versus, other companies in other sectors.
So I think it might be an important time to also address, as you think about I'm sure there's probably a lot of companies that are coming to you that probably shouldn't be seeking venture capital. And, can you just clarify, even for some of the founders here, like what really is a venture fundable company and when should someone consider different types of funding?
I think that for venture, and it's gotten, I guess it's a little bit different now because, look, for me, I think a venture backable business is a company that I could invest in that has and I'll just speak specifically for our thesis with our strategy is we invest in companies that we look for that are between $15 and $20 million in valuation. And for consumer, that means something much different than deep tech, but just for consumer, that means, you have a product in the market, you're doing anywhere from $3 to $5 million in run rate. You have a healthy unit economics and margin, path to profitability. You have that 3-to-1 fundamental law of growth in terms of customer acquisition to LTV. You have, your sort of supply chain dialed in, you have your distribution dialed in. And so it validates to me that, you have a viable business model and you have a product that people want. And now it's time to pour gas on the fire. And for consumer, I really don't think, again, you need to raise more than $10 million total. I would want to invest in the post-seed round. I think the company can raise a Series A, and then maybe that's it. And the goal for me is to have conviction that this company is going to exit, get acquired. For consumer, it's probably going to be an acquisition, but there could be an IPO. The minimum would be a $250 million, exit opportunity. So I'm investing in companies that are between $15 and $20 million. There's an exit opportunity of $250 million. If you do the math and you, calculate for dilution, this is very like back of the napkin. We're looking for, 10x return potentials for all the investments that we put money into. And those are venture backable businesses to me. Those are the types of opportunities and the investments that I think the venture asset class really is looking for. Again, minimum. I think because it's a long-term illiquid asset class, you really, and from a risk reward standpoint, it's very heavily skewed on the risk side. So if you're going to take all the risk up front, and you're going to want a much higher reward. So those are the types of things we think about, or at least for me, when I invest in these categories. And is this a venture backable business? I don't, again, it could be a drink company, it could be a direct-to-consumer toothbrush company. It could be a consumer software app. It could be a VR or AR platform play. Whatever it is, whatever sector it is under that consumer kind of umbrella, I really, when I do my diligence, I'm looking at it from the standpoint of what can this company be a $250 million exit? And if it, and if I get to a yes, then there's a high probability I'll invest in that company.
Okay. And the question from Anita, I think a follow-up is, how do you make allowances for not dealing in pattern matching, i.e. investing in the same old? How do you see new forces, new patterns of founders and businesses and different voices?
Pattern matching is interesting. And yeah, you kind of want to leave your biases at the door when it comes to investing, even though it's much easier said than done. And so, yeah, you kind of got to look at the variables of each company when you diligence them. You have to have, it's really a great skill to have short-term memory loss, I think, in venture, and selective memory, maybe short-term memory is better. But you look at, there could be multiple, there's a lot of times there's multiple companies in a particular space. A lot of times the timing is wrong for those companies. And so if I invested in a company in a particular space 5 years ago and I got burned, I still have scar tissue. And then if I look at that company again, or if I look at a company in that space again, I'm going to have all these biases and sort of, things that come up for me, feelings that come up that are unpleasant. But I really have to think about, this is a new team. This is, with a new perspective, building something new in the same space, but maybe trying to solve the same problem, but maybe trying to solve it in a different way. And also the timing is different and the market is different. So that's the huge thing. We live in a very fluid and dynamic world. And so I think a great example of this is AR, VR. I was looking at a lot of AR, VR companies, and they were super hyped up, 6-7 years ago. And, it just, I got a sense that this was really cool technology, but the cost barriers to entry were really high. The hardware was really high. Oculus was just coming out with their first model, and it was like $800 or some, I knew that this wasn't going to be practically applied into the consumer market anytime soon. It was just too early. And I thought, even though there was a bunch of hype around it, I just didn't feel like I needed to wait. And I think there are a lot of investors who did invest in VR, AR back in those days that were excited about what the promise of what it could be. And, then it kind of the hype died down. And now, it would be interesting to see if they would be interested in this, if they're still excited about the space, because I'm super excited about the space, because I think the time is now for AR, VR. And so I'm looking at a bunch of those types of companies, and there's not a lot of money going into that sector relative to what it was 6 or 7 years ago. And that makes me excited as an investor. So all that's to say is, I think when it comes to pattern matching, you should not pattern match at all, except there is one exception, I'll say, and this goes back to my people focus. And I'm starting to see, I've looked at so many companies now, I've invested in, worked with so many founders, that I'm starting to see similar heuristics or characteristics of people that I think, I get a sense of, these were the companies that were most successful in my last portfolio. And this new company that I'm looking at has a founder that reminds me of one of the old founders of one of my most successful companies. And I think that could be TBD. We'll see. I'll have to come back to you in 6 or 7 years once I get the performance back from this new portfolio. But I'm starting to get a sense of okay, this person's talking about their business and knows their business the same way that this other founder was. And this founder, was really successful. And this founder reminds me of that old founder. And so therefore, there could be some correlation there in terms of success. So maybe you could pattern match with people, but maybe not pattern match with business. We'll see.
Susanna has a question to add on to that. She says, how do you feel about founders who have 25 plus years of consumer marketing experience? Because it seems like much of the funding is going to 20, 30 something founders. Any advice on how to best sell?
So yeah, this is like kind of ageism stuff, because you want to, the experience is really great if you have 25 years of experience, but how relevant is that experience in, again, these new business models and these new forums and these new markets where if you ran a consumer company 20 years ago, it is much different in terms of distribution and marketing and sales than it is today. So part of me would say, how relevant is your domain expertise? And you just, through a conversation, we could suss that out and I can vet that out. Again, I think the relationships that person would have, is exciting. I would just want to make sure that person is staying up to date with all the emerging trends and the new trends that are happening in the space. And I would just be reluctant. That would be the one, thing I would be reluctant on, working with that person or backing that person if I felt like their knowledge was outdated, versus a new, young, hungry, ambitious entrepreneur. They don't have the experience, but they can learn very quickly, and they have, and they're resilient. And again, like, they're not going to stop until they figure out. And then it's the mentality of, like, sometimes it's better to not know the rules of the game, because then you can break all of them. And I think sometimes to win, you do have to break all the rules. If you play by the rules that are outdated from an old game, then you're just not going to win in this new game. So you got to think about it from both sides.
Cool. Joanna asks, as an investor, what do you think about a CPG food company during private label for cash flow and economies of scale?
A CPG company doing private label?
Yeah. Joanna, could you clarify what specifically you mean? So what I'm reading is, what do you think about a CPG food company during private label for cash flow and economies of scale? Not clear to you?
No, I don't really know what that means.
Joanna says she's doing private label.
Private label.
Joanna, maybe you could rephrase your question. She says, for large retailers with their brand. Oh, so she's white labeling, I believe.
Oh, she's white labeling her company.
Yes.
And so the question is when it comes to cash flows and economies of scale for a white labeled company?
So essentially, I mean, then that's not a consumer product.
Right. Yeah, that's what I'm confused about.
Okay. Joanna, if you want to rephrase your question, we will get back to you. So Becky says, just curious, how do you see product packaging evolving in the CPG industry? Is that something you all consider when making an investment? And do you see CPG startups thinking more about the life cycle of the product packaging?
Totally. Product packaging is huge. And again, it coincides with this idea of taking an omni-channel approach. And, some of my best consumer companies use retail as a customer acquisition, Trojan horse for customer acquisition, in Target, in Bed Bath & Beyond, in some of these large big box retailers. They can't compete on price alone anymore. So they can't compete with the Amazon. They need innovation on the shelf to drive, new customers and old customers to keep coming back to the store to discover new products. And so when they come to the store to discover new products, you want the packaging to stand out. And so a great example of this was Elle Femcare. Elle Femcare got acquired by Procter & Gamble beginning of this year. They do femcare products, tampons, pads, liners. They were competing with Tampax and Always. They had organic cotton. They had a Tom's kind of one-to-one model for every product unit sold in the US. They would donate a product to a woman in need in a third world country. So they had the right just a great product, an amazing story. There was social impact. There was a level of altruism and philanthropy involved. So the customer felt good. But for me, the thing that they had really going for them that I thought was the biggest competitive advantage was their packaging. So when you go into Target and you walk down the aisle of the tampon aisle, you would see, the standard sort of packaging. And of course, like Tampax and Always would try to change their branding and put like cool neon colors on their packaging and so forth. But Femcare literally changed the entire form factor of the packaging. And it had these cylinder cases of tampons with like, that would attract millennials and I spoke to the founders about this. The goal and the mission, what they were trying to do is make women feel less shameful about having their tampons out in their bathrooms. And they achieved that goal by creating a product that looked like an art piece by virtue of the actual case that the tampons were in, and then also the packaging for each individual tampon. So, and then Quip is another great example. The direct-to-consumer toothbrush company. If you ever see a Quip in store, they have a dedicated kiosk now in Target, in airports, variety of places, and it looks like an Apple, setup. It's got, just like very sleek. The traditional toothbrush packagings were just these like plastic casings that you peel the back off and whatever. This is like a whole, it's an encased kind of tube that the toothbrush comes in, and then it's in this like very glossed over silver lining packet. And there's again this like self-expressive benefit that comes with it, where it feels like, wow, I'm like brushing my teeth with an Apple product. And I think that starts all the way, the beginning of the funnel from the like first time user experience when the customer purchases the product. And a lot of that is predicated with packaging. So I'm a huge advocate for packaging and, incorporating that into your branding strategy.
Awesome. One additional question. So, all right. So Joanna has rephrased her question. She's saying, I am building my brand, but as we are ramping up, thinking about putting our product in retailers' own brand lines like Trader Joe's to get larger production runs and have cash flow to continue to build brand.
So white labeling. So yeah, I don't have a lot of experience with companies that are building a product to white label to another brand, to a Trader Joe's. I would assume that would be more of like a licensing kind of business model. I don't really know how the economies of scale, maybe they would apply the same way, where again, like the more volume that you do, the better deals that you'll get on your cost of goods. But I don't have a lot of experience working on white label consumer products like that, so I wouldn't be able to speak to that.
Cool. So another question from Vanessa. She says, my company was just approached by a foreign investor group about investments via the E2 and EB5 investor visa programs. What are your thoughts on companies receiving such investments?
I don't have experience with that either.
And maybe it's just even a question on international companies.
Right. Yeah, I mean, look, for me, when it comes to just the premise of equity financing, I think all equity financing should be strategic, particularly for consumer companies. I think you should be selective with who you take money from. And I think if you're going to give away a piece of your company, you should get something in return for it outside of just dollars, because for CPG companies, there are a lot of funding channels that you can take, less expensive money from. So if you think about a foreign investor, is that foreign investor, how are they going to help you? If they're going to help you by virtue of, helping you with your visas, and that's an important part of your business, and that's the strategic value add, then that might be something you want to consider. For other VCs, for me, if I'm launching a company in the US and I'm looking for, I'd be looking for help from my investors for, again, like relationships with retail, recruiting, marketing, anything that can give me sort of an advantage in any of the areas that can help me build my companies. If my investors can help in any of those areas, then it just makes me feel better about having them come in as an owner of the company. So that's kind of the way that I would think about it. I don't know if this foreign investment, you can take foreign investment is fine. I'm just wondering if they're all the way in, Southeast Asia and they're giving you money, what's the type of value that they're going to really be able to generate for you if you're launching in the US? Maybe there could be some deferred value as you expand internationally, and maybe they can be a foray into helping you grow into the market that they're native to. That could be interesting if you think about like a global expansion plan. But just sort of have the mindset of, taking money from people who could like materially help your company grow, I think is probably a good start.
Cool. Well, with our last couple of minutes, I just wanted to wrap up with what's just one piece of advice that you would, just actionable advice that if a founder today is going back and working on their company, that you would give to them?
Actionable advice. Let's see. Okay, so don't think about raising money until, I think financing strategy is really important with CPG companies. And I think there is enough you can probably build with some like friends and family money, your own savings, not a lot of money that you need to get your product off the ground in market these days. And I think you got to go back to like the mentality of being a scrappy entrepreneur. CPG, like we have this mentality now that it's like, let's raise money and build a company. I actually think that with CPG, it's like, let's build a company and then raise money when we need it. And then let's decide how much money we need to raise, like responsibly to get to the next level. And I think there's, let's go back to basics in terms of being an entrepreneur. Let's be capital efficient. Let's, build a proof of concept, get it in market, get some traction. There's a lot of tools that are available for us to like do that these days that are low cost. And let's get the validation that we need to show that we built something that people want, and then take time to raise money from the right people to get the company to the next level and do it in a step-by-step process. I think is really important. Awesome.
And great way to end. And do you have a way for people to contact you?
Sure. Yeah. What's the best way? Should I do my email address or my website or what?
Whatever is easiest for should someone contact you.
Yeah. You know what? Go to because email.
Whichever is easiest for you.
I think it'd be cool for people to go to the website and like see what we're all about. So go to alphabridge.vc, and then there's like an intake form at the bottom or contact form at the bottom. And so if you like what you see and you want to learn more or talk to me about your company, then fill out the form at the bottom and we'll reach back out to you.
Awesome. Cool. I will thank you so much, Howie, and I'll turn it back to the Alice team.
Thanks, you Lisa. Again. Thanks, Howie. Thanks, Lisa. That was a fantastic session. And thanks so much for sharing your insights today and helping answer all these questions. Just a quick shout out, Joanna and Vanessa, I would highly recommend you post your questions in the WomanMade community, where there are peers and experts popping in every day that might be able to help lend a few more insights to you as well. And then a recording of this session, as well as more helpful tools and resources, are also available on that WomanMade community. Next week, we're hosting a PepsiCo expert, their senior director for marketing. And then we're back with Lisa Wang next week for another AMA session with an investor. So looking forward to seeing you all then. And thank you so much for tuning in.
Bye.
Thanks, everyone.
Bye, everyone.